Okay, I am going to be doing a review for today, the 22nd of July. It's a Tuesday. We had some pretty cool setup playouts this morning that was very similar to the previous day, and it's a model that I kind of have been getting more familiar with these last few days, and I'll show really quickly what it looks like. If I drop the 15-minute on this side. So what I caught this morning was this old low on this side. Drag that out, whoops. And you can see we dropped into it, had a nice 3-drive pattern, and then had this nice rally up to the London high. So that's what I caught today. And why I say it's something I've seen a few times is we got the exact same thing back here. The previous day where we had dropped below this old low. And these old lows are quite specific, which is the nuance that I've found the last few days and I want to dive deeper into. But that's essentially it. I'm just going to paste just the new day opening gap from this day and new week opening gap on this chart and the midnight price, and I'll jump over here and I'll actually do a quick diagram of what the model is. So it's a framework, and it's called the trailed stops hold high/low. Might change the name up a bit, not sure, but essentially that's the framework. And the idea is that we have a very directional move. So you know that whoever wants to chase this move, or whoever is long throughout this move, they now need a place to trail their stops. And then we engineer a nice obvious swing low, like that, and entice away from it. And now at this point, you can be sure that whoever was long down here, whoever's long here, whoever's long here, they need a place to put their stops, and everyone's going to put their stop there, and you're going to have a large liquidity level at this old low. The market's then going to entice high, and then eventually attack that level, and then it might come down again and attack it again, whatever, and maybe it does it a third time. So now you have a 3 drives pattern. So once it's done this and you know that it's clearly accumulated, that might be seen by a market structure shift displacement through this intermediate term high, and then you're looking to essentially buy at this old swing low. So maybe we engineer some relative equal lows there, entice further, and then drop down there. And that is the idea, is that we continuously refer to this exact level, this old low. And that's how I pick out like what old lows and old highs to use. Like if there was this is an old low, like sure you could also use this potentially, but it really wants to be the most obvious level where trailed stops would reside. So I'll show a couple of examples on NASDAQ and on gold as well. So this is a very nice one from the other day. We have this move up on this way, very directional. We have this big impulsive rally, pulls back, makes this low here. So if we drag that low across, the reason I'm picking that is because a very impulsive, enticing move. We then pull back, and whoever was chasing this long, they were going to jam their stop loss up against that. We then make another high and then just roll over again. Accumulates with 1, 2, 3 drives. So you can really see that we have accumulators down this level. It's a very common pattern to have, that when you see that and you're already expecting that we're accumulating a certain sell side liquidity pool, then that's like your confirmation. And then we get back above this old swing low and use that as an area to reaccumulate. Then we have this day here. So the reason I picked this low is this is Thursday, had a very strong up move, and then right before the close, during regular trading hours still, we make this 4 p.m. low. The next day, it opens up, and the only place for trailed stops, sure you can put it there as well, but the main one is just this really long wick. It looks like a strong bullish rejection. Everyone's going to put their stops there. We then work way higher, entice longs, and then drop down and spend a bunch of time accumulating. Sorry, I just want to get rid of that line. Accumulating below that low before Monday opens up and runs back above. Then engineer a sell side pull just above it. Continue to entice longs, consolidate, and then drop aggressively into it just before the 9:30 open. And we get this nice move. So that brings me to today. And the reason why I picked this particular low, this low, sure, you could argue that would also be a good spot. But the reason why I picked this low is, one, this is the London low right there. And we have a really enticing rally straight from that London low. Big displacement, it looks super bullish. Everyone wants to buy this. We then continue to make another high, but then it just really loses momentum and just starts consolidating. Whoever's chasing this move, anyone who got long on this entire range, their stops are going right there. And so I had that drawn out this morning. It also lines with this bullish order block, and we're actually very bullish on the high time frame. I'll jump back over to this chart. We'll go to the daily real quick. We are ultra bullish. So obviously we've broken the all-time highs. We then had this fairly tight consolidation for a few weeks. We get this long wick, breakout above relative equal highs, trips and longs, drops low the very next day on Wednesday, and takes out those trailed stops. That is this area in here that I mentioned with the 3 drive pattern, 1, 2, 3 drives. I even do a little circle around them. So that's that pattern right there. That's on this wick down. And then following that, we close the day with a very strong rejection back up. So at this point, we have tripped in longs, accumulated those longs, the stops from whoever was tripped in above these highs, and then close the day with a very long wick on both of the candles. But the narrative is that this wick was engineered to entice shorts, so trip in longs, and then also get anyone who is bearish. They see this big wick, they want to sell. Smart money accumulates down here, buys, and there's a very key signature that is called long wick plus displacement. Is when we get a very long wick, such as this one here, and that's immediately followed by a fair value gap essentially, rather than without dropping down to the midpoint of the wick. So we failed to reach the midpoint of the wick. We basically didn't even go into the wick at all, and we just rip higher and leave a fair value gap. That's a extremely bullish signature, and that's why after Friday had this read to closing day, making this pullback, I was extremely bullish going into Monday, and we had this really big move that could easily be anticipated for that kind of strength as soon as we printed this signature. Now obviously you don't want to be picking tops, so I was also bullish today. It ended up to be dropping down for this low down here, which will likely get referenced again if we pull back low enough. But this offered a really nice long to start with, and we have obviously a bullish order block that took out all the sell side. The old low that I mentioned, if I drop to the 15, that old low where we have that displacement, a really obvious low engineered, and then just a lot of time for stop losses to accumulate below that low. On top of that, we also have Friday's new day opening gap. What I've noticed is the best way to select what new day opening gap to look at to narrow your focus, because it's not much help when you have 100 different new day opening gaps over your chart. So if you just refer to the one of whatever previous day high or previous day low we've just run, that's usually a very influential one going forward. So that's our previous day high. If I draw that out, I'll even make it a dashed line so we can kind of see that it's the PDH. But so we ran this high, so we refer back to this new day opening gap, draw that out, and you can see that that was also in the same kind of area for confluence. Dropping down a bit lower. If I turn on the hourly open indicator, it just shows each of the hourly opens, and we're looking at where we are in relation to an hourly open to determine premium and discount. Also, midnight obviously is a fair value level, and we consider it premium above and discount below. So during London, we engineered all the sell side, very high resistance in here, and then had this enticing move up at 3 a.m. Bit of consolidation at the highs, then aggressively drop back down, took out the low multiple times before working our way down into this level. So this is where I was watching the charts and looking to accumulate a long position. Now if I drop down again, so I'll keep this over here just for reference. So the first thing I noticed was how we perfectly touched the level here at 447. I'm still haven't observed this very much using these particular lows. Like I've been using the super old low level framework for a while. Like I came up with that a long time ago, but I've only started deciding that maybe I should be referencing specifically where trailed stops would reside recently. And then today we come down and we have this perfect retest of that level, really strong rejection, which I thought was interesting. We then dropped down a second time and a third time, and I was looking at this low. I thought, okay, cool, that's a sell side pull. And now we've done 1, 2, 3 drives below it. We got the CSD. I saw 5 a.m. had taken out the 4 a.m. low as well. And so I actually got long right here. Eventually, as you can see, we went sideways. And around this area here, I started deciding, okay, this is looking like it wants to take out the low again. I held on to the position though on the practice account, but I was anticipating we were likely to take out this low again, and I was also prepared to get back in should we do so. So eventually at 5:42, we do that. We drop down, take out the low once again, and at this point it was a lot more clear that okay, this was actually 1, 2, 3 drives, because if you look at kind of the structure, you can see we make a really obvious low that takes out this low there. We then have a pullback, make another low. That's not really a pullback. That's kind of the same directional price action. Like in fact, there is no buy side delivery within this range. There is internally in this small range here, but from this candle's open to the low, we never come back above the high. So that's continuous sell side delivery, meaning that is drive 2, there's drive 3. There doesn't have to be 3 drives, but it is a strong confluence when we have that. So once we get these clear 3 drives below a very obviously engineered sell side pull, this very sharp low right at 4 a.m. and then we get a nice sharp reaction. There was also, if I bring up ES, So you can see there was also SMT with ES. ES making a high low there to start with, which is partly why I took that long. And then once again, still making that high low with this candle here. So we had clear SMT on the lows. We had taken out the sell side pull after having hovered above it for a long time, and we got the strong reaction. I don't usually use inversions particularly much. Like I just use them to read what order flow is doing, but the first thing I noticed was, yep, we did indeed start showing a lot of speed up through this inversion. But what I was more interested in is, do we get above this short-term impulse high and do it with speed and not just go up there and reject downwards. Also, watching this range, this is what I'd consider a good mitigation block if we were bearish, because we essentially trapped longs above it and then drop down below it. So usually if we were bearish, you'd expect this range to hold. So when we displaced above that short-term high, displaced back up through this range very easily, while I'm anticipating that we should be accumulating along at this particular level, and had that SMT, so I jumped in as soon as we got above this for a long, the CSD, and yeah, bought in this area. We then have a failure to retest the 80 level right here, so find it, there we go. So we displaced above the 80s and then failed to retest it, so that's often a sign of strength. And then we get this really nice run up into the range. If I drag that from the high to the low, you can see the EQ is roughly here. And we easily hit EQ, hit this volume imbalance, good place to take a partial. And yeah, so I held on to the bulk of this position. I took partials up as we hit these highs and at EQ of the range. But when I saw how we'd actually failed to reach this new day opening gap, I recognized that that's also a signature of strength, and so we're likely to have a larger move. So rather than taking everything off as we lost momentum, I held on to it, but I trailed my stop to break even, which just happened to be about here. So stop loss at break even. I'll show the executions in a bit as well. And yeah, that comes straight down, takes me out, and in here, I was kind of in two minds of it, because so I'm on my demo account, my practice account, which does help because it takes the emotional decision making out of it. But I found myself in a situation that I find myself in too much, where I get stopped out exactly where I want to be long. So this obviously is accumulation. Below this low, we have these 3 drive pattern and then displacement away from an area we were expecting us to accumulate. So this entire range, anywhere in here, is essentially a previous area of accumulation. So when we drop back into it, we're dropping in to reaccumulate, which is an entry model in of itself. So once it gets stopped out, I'm then thinking, okay, well, that's really where I want to get long. My reasoning for moving my stop right there was actually based on the 5-minute chart, and I saw this displacement, and I figured that because of this range on the left, all this is very balanced, a lot of price action, this should be a breakaway gap, which it wasn't, and that is likely one of the precursors for this lovely sell-off at the open. But just because a signature fails doesn't mean that the price is going to instantly turn around and go the other way. It just means that maybe be a bit more cautious with with longs going forward. But yeah, in this case, have that 5-minute fair value gap, gets closed past the midpoint, and then it takes out the low of it and took me out. I didn't jump in right away, despite liking this area of accumulation and wanting to buy this, because I figured it's the exact same mistake I've been making on my combine when it wasn't blowing, where I'd get stopped out and then be like, well, actually I still want to be long here, so I end up getting long again, and then all of a sudden it's like I never had a stop loss because I just keep buying the dip. So I let that stop me out. I watched all this through here, and I was watching this 5-minute wick, and I wanted to see if we could leave that unfilled. That's another sign of strength, and we do. We fail to reach the midpoint, and then we start rallying higher. And at this point right here, what I'm watching is this old low. So in a similar kind of way, this is kind of a bit different of a low because it's not really where the trailed stops would be from this rally. I'd be more referencing one of these lows up the top. So if you think about it, if you bought down here and you want to trail your stop, you're not going to put it lower, you're going to put it higher. And so my eyes actually jump right to this one, which we'll draw out later. But in the meantime, this low, the pretty much not the London low, but a very major low, we have clearly accumulated in this area. We've just reaccumulated in that previous area of accumulation, and then started displacing higher through this range, and also back up to the, if I could grab this out, 300. So right there is 300 even. So a key support resistance idea type of level, institutional level. So once I saw us run up back up to this high, this false high, we had clearly reaccumulators displacing higher. I saw 7 a.m. open, do a institutional order flow entry drill into this fair value gap, have a displacement higher, and as soon as I saw that we were clearly very strong based on the signatures and the fact we just had reaccumulation, which is also first stage of the market maker model pretty much. And so I was looking for a lot of strength and momentum. So I actually took a momentum scalp here, which worked out quite nicely. So I saw we had the IFED, we were very strong, we had a clear draw on liquidity, so this buy side up here, there was nothing else within this range. There was room for me to, as soon as we hit the first buy side pull, the short-term high, I was go break even. And yeah, and we had a immediate rebalance. So immediate rebalance at 702, I bought that, and then we have this nice push up. As soon as we hit this short-term high right there, I did take a partial, and that's because that could reject price, but it didn't at all. Or it just had a small pullback and then had a nice big push above these highs. So that actually ended up to be a really nice trade, and I took a few trades like that today where it's a very much momentum based entry. And the idea is to recognize where signatures of price action and the current part of the market maker framework we're in suggests like a lot of momentum and speed. And then you're getting a tight entry with a tight stop, and then looking to take something off the table quite fast, get to break even, and then just ride the momentum, and ideally trail using a 2-minute stop loss, which I did in this case, and was stopped out somewhere around here. So yeah, it came back quite a bit against me, but still ended up to be a very good trade. So if you think about if that's the entry, not the best entry, and then you're targeting up here, let's say the 20s, and then you're taking your first partial up here, which is about 1-to-1, and going to break even. So risk off, and you've already banked something. That ends up being quite a nice trade. So at that point, we have the next setup. And over the weekend, I was rewatching one of the old, what's it called? One of the old model vids that ICT gave out in like 2017, I think, mentorship. So one of the charter like price action models, model 12. And how he describes it is you have a order block. I'll just do it in the 5-minute chart actually. You have an order block, and you see price return into the order block, and then it displaces higher. And the trade that he's talking about is you then look for a 5-minute fair value gap and you buy the fair value gap. Pretty much it's second stage of a market maker model. And with a market maker buy model, there is always at least 2 stages of it. And in this particular scenario, you can easily recognize the smart reversal, short-term low, intermediate term low, short-term low, making that first stage, and then we rally up. And so you can expect us to likely put in another high. So I was watching this fair value gap, and I figured that would likely be a good place to get back in after I stopped out around here in profit. And I was watching as we dropped down and figured that on the 5-minute chart, similar to how I did down here, I figured that we shouldn't really be coming too deep into this range. I could also see how we did have this old low, so I wanted to allow it to dip back below that. However, we'd already done that with the 7 a.m. open. So once we dropped down, I saw that we were respecting this 5-minute fair value gap. And so right in here, I got long with a stop below the 7 a.m. low. And yeah, it started playing out, started moving higher. As we hit this high, I really like the narrative I saw here, so I'm going to move this other way. I like the narrative that we had this really sharp move back down. Whoever was looking for a shorts throughout this entire rally, who wasn't taken out or who had enough capital to get back in, they finally caught a short. They've given plenty of time to get short right here, and then there's another leg lower. So if they weren't short here, they're short here. So then we start crawling back up, and I figured that, okay, well now we've got trap shorts within this wick. So there'll be a lot of stops up here, and I expected price to just keep on pushing up. And as you can see, it did easily get above the midpoint of that wick, but then it fell short of the high and dropped down once more to put in a failure swing. I already had a position on here, and then I added as we ran up into the high, thinking we'd just continuously push through, but that wasn't the case, and we pulled back once again. As I just held on to it, I was trying to risk 200 per trade each day just to try and get consistent with that. And when I added onto this position, I was thinking I'd be trading my stop up, but then when we pulled back so aggressively, I figured that I can't exactly put my stop right here just yet. And so I ended up risking 140 or so on this position, but held on to it, and then eventually 742 have a nice aggressive push up. Took partials as we hit the highs, and then it just worked its way up, and I trailed the stop and using the 2-minute trailing stop, and eventually closed out. Well, I trailed it to this low right before the open. I figured it would probably get taken out, but I was expecting we would likely head down towards these lows. But yeah, it ends up being a really nice trade. Executions aren't the cleanest, but they're a lot better than they've usually been in the past. So I'll jump across to that real quick. It wasn't this account, it was this account. This is actually ineligible. Already finished it off yesterday, but these are the executions, and you can see I had 7.9 out of 10 conviction. There's that old low, that engineered sell side pull. We we drop down, do that 3 drive that I thought at first was the 3 drive. I bought as soon as we started climbing out, so right there, a very nice entry right at the open. Added to it on this pullback, figuring that we should leave some sort of a breakaway, especially with the narrative of this long wick right here. And then eventually we're just sitting, going sideways, and around here, I figured, yeah, it's probably going to roll over again, especially because it's taking out all these lows multiple times. And I added right here, not because I thought it was going to go up all of a sudden, but because I had written down in my my goals for today, that I want to be risking 200 per trade. I didn't have 200 risk on yet, so I added to get my risk with my stop loss below this short-term low up to 200. And yeah, then just was taken out for that 200 loss. But because I was anticipating this, to get taken out. So I was watching very carefully within this range, and I noticed, okay, we closed above that fair value gap. And then as soon as we got this displacement through that short-term high, jumped back in at 79s, using a limit, but dragging the limit up to where I wanted it, which is below the 80s essentially. And then getting this nice run up, took some off at 92 as we hit this buy side and EQ of this dealing range. And then I figured, okay, actually this is looking really strong because we failed to reach that new day opening gap down here. This is actually probably going to rip, and this should be a 5-minute breakaway gap. So as you can see, I added back in as we dropped below the short-term low. This is also EQ of this range from this low to this high. I figured displacement through EQ, dropping back into that, should be a breakaway. So I can put my stop down below the breakaway gap and add to it, which I think is logical, but it just turns out that we were bearish after all. But yeah, so got stopped out, as I mentioned, didn't jump back in until we got this signature. So the IFED at 7 AM through that old low from over here. That's referring to that low anyway. And then we got this displacement, and I recognized that this is a momentum scalp opportunity. So we had a clear buy side pull, and then we had this short-term impulse high up here where we could reject. So got long, I did very good with the sizing right here, got long at 4.75, and if you measure from 4.75 down to where I put my stop, it's 10 handles, so 200 risk with 10 contracts. Took a third off at 10.75, so right there, just a tick below that short-term high. Took off some more at 17.5s, so gave it plenty of room, margin for error above these highs, and then usually I expect it to hit the 20s, one of the institutional levels, and then I just go a few points below that just to make sure I get a fill. So I got 6 out of 10 off, and then was stopped out in the remainder using a 2-minute trailing stop right there. Then you can see the 5-minute fair value gap, which is right something like that. Adding at the low end of that with a stop down here. And then as we ran into this wick, I figured, oh, it's a great place to chase, essentially, and then have this aggressive pullback. So wasn't really expecting that, and that did put me oversized a little bit. And having this nice push up, taking profits at, so 3 at the 24s, so just there, and that was, like, I wasn't expecting it to move this fast, so I kind of had to just mark it out. And then when I saw us pulling back this aggressively, I was like, I better take a bit more off. So I had 13 on, I ended up taking off 8, all within this range from there to there. So pretty good fills for majority of them. And then taking off another 2. I was going to let that run a bit higher, but I was feeling a bit uncertain about all these smooth lows down here, as you can see. And the fact we had these smooth lows down here as well. I thought, okay, maybe it's just going to tap this high and then roll over. So I took off another 2 there. Then I had 3 left on. Took 1, just running out equity as we hit this premium civvy. 1 there. And then I was trailing 1 below the 2-minute low, and that was stopped out there. And then I had 1 left that I had my stop loss sitting just slightly in profit above my average, and I held that all the way up till just before the open. I figured, okay, it's probably going to come down here, so I'm going to trail it, and it did. So yeah, that was that long. And I did mention I was going to show a gold example as well, which I might as well really quickly. And then I want to jump on to the rest of what was happening there. We have gold. So the hourly chart will do. Big rally, big enticing move. We then pull back, make this really obvious low on a Thursday before a long weekend, I believe. You can already see what it's lining up with. But this is now a Sunday. So Friday was a public holiday. So we engineered a really obvious low, consolidated, and then opened up for a Friday public holiday and continued to consolidate. So we essentially have 1.5 days of price action above this really obvious low with a long wick. Long wick means strong bullish rejection in a lot of people's minds. So there's going to be a lot of sell side below that. We then do 1, 2, 3 drives below it, run back up. We refer to it right there. That could be a long opportunity. We do the same thing over here, refer to that exact same pull. And part of how I think of this is if you imagine a fair value gap, let's say you have a price run like that. Yeah, whatever. Very ugly, but this becomes a fair value gap. So if we have let's do that. So between this high and this low on some time frame is a fair value gap. And if you imagine that this low is maybe a bit more pronounced, a bit more obvious, that makes, let's say, an hourly fair value gap high. This could essentially be that trailed stops liquidity pool. And if you are familiar with ICT concepts and how price moves when you look at price this way, you'll a lot of the time see price come down and refer to the midpoint, then come back, return to the high of it, and that's often done. And if you think about it, okay, it's clearly referring to this low and this high, but specifically this low, and then after getting back above it and accumulating within this range below that trailed stop pull, it refers back to that same old low. Or it might reprice all the way through it and then come back above it and then respect CE, the midpoint or the high. But essentially what I'm getting at is that it's referring to this level. And if you look over here, if you grab whatever time frame, you're going to say, okay, well, let's say a low and a high, drag that out. There's your fair value gap. Refer to the low of it, get below it, get back above, and then support it at the high. We then have in here another example, drop to the 15. So relative equal lows, a really big enticing rally, and then an aggressive pullback before closing the day. If I put on the session dividers, so closing the day here. So we engineer a really obvious low after an enticing rally, and then consolidations to close. Trailed stops go here. Guaranteed they're there. We then sell off the next day, accumulates at that old level, rally up, and now engineer smooth lows at this level. And at this point, you could say, okay, this is the pool I want to refer to, and expecting us to accumulate at that position. You can see we have 1, 2, 3 drives below it. So that's one confluence that we have accumulated below it. 1, 2, 3. And then if I drop to the 1 minute, maybe that could be your signal to get in, something like that. Or even as we get back above it, try and get positioned up here. But that's the idea, is that we have a previous low where we know trailed stops would be, and we're looking to accumulate below that level. And you'll find that there's a fractal of this kind of model within this range. Maybe you can find where trailed stops would be from this rally, or something in here like that. So, and you could draw that out. Maybe that could be, your entry model. But that's that example. But back to NASDAQ. This is a glitch. I'm going to refresh the page real quick. So there we go, all fixed. So the reason why I expected us to come a bit lower is largely, okay, of course, there's the facts that we were closing in gaps that should have remained open. So not showing much strength, completely filling in this fair value gap, not showing much strength at all. And then we'd obviously tap this buy side, and on the higher time frame, sure, we're super bullish, but if you think about it, in this entire range, where's the discount sell side? Down there. So all the way at the lows, which explains the nice drop we had this morning. But we did have this hundreds level, as I mentioned, and we made relative equal lows at that level, and we're spending the entire time above 6 a.m. and above 7 a.m. So we're at a premium, and we have pivot equal lows at this level. Let's aggressively sell off into it. And then I was watching this, so I figured that, okay, it's come quite low. We just fell short of this short-term low, the 6 a.m. low. We have this point of interest down here as well, and it just did not look like it was going to stop right there. So I was watching, okay, how far up do we climb? We were making all these long wicks. That's not something I want to short until we show that we aren't going any higher. And we did that as we printed these long wicks, got up, and then eventually failed aggressively. So this is that signature I mentioned earlier, the long wick plus displacement. We have this long 1 minute wick. We don't go a single tick into that range and then have a displacement candle out of it. The next thing is all of this is very balanced. So this fair value gap you expect to remain unfilled. We then have this lower fair value gap. And I had a clear idea of where price like low. We've got that new opening gap down there, but then we've also got sell side all the way down here with actually regular trading hours we had this low, so that was really standing out to me as a likely draw, and that was the thing that made it quite easy. But if I go to regular trading hours real quick, you can see that that really stands out as a place where there will be liquidity. So at this point, we had shown a signature of weakness with that long wick plus displacement. We then showed a institutional order flow entry drill by entering into this fair value gap on this candle and rejecting aggressively. The very next candle falls short of that sell side pull and rallies back up. And so I figured, cool, this looks like a very good short. Long wick plus displacement, this should remain unfilled, so I can put my stop loss above the midpoint of that fair value gap very safely. And it's likely to at least reach here, and with the weakness we're seeing, it's probably going to go even further. So I managed to catch this short, and then taking partials down here, going break even, and then trailing the 2 minute stop loss wouldn't have got you out until all the way down over here. So really nice move, and I'll show you the executions for that. So for the executions, I forgot to mention actually, I also took a long in here, and reasoning for that was the long wicks, really aggressive move in one direction. I'm looking for people to be trailing their stops above these long wicks. Then when we get multiple long wicks like this one here, and then a second one, and then straight after printing the second wick, we aren't rejecting again, we start showing strength again. So I bought on the return back into the midpoint of this wick and targeted just the 300s, it looks like. I might have got stopped out actually. Can't remember, but in any case, that was the logic behind that. I was thinking that if this is a bullish move, then it should go up and fairly one directional, and ES was showing a lot of strength. That was the reasoning, that's right. So ES was ripping really hard. We had these long wicks, so I figured the narrative was that whoever was chasing the short was being enticed to continue shorting up and through this range. ES was showing strength to the upside, and so I was getting long and trying to catch that rally, but it never happened, so I got stopped out at break even. Got to break even nice and fast. And then we had this, as I mentioned, the long wick plus displacement. SMT with ES. ES has taken out the high. I'd already gone break even because of ES doing that. And then we drop down, and as I've already explained, we have that regular trading hour sell side. And I sold at 82.75, so right there. So as we ran up and took out this high, I sold on the way back down, and then covered at 4 out of the 5 at 57.5. So right below the swing low, I covered out off 4 out of 5. Held one runner, but then I decided to take that out down at 38.75, and that would have been, there was a liquidity level down there that was targeting, so I just took it out there. Had I just trailed using the 2-minute trailing stop, however, which we'll jump over to, if I just trailed with the 2-minute trailing stop, as you can see, I would have caught this entire movement all the way down to this swing high right here. So that's where I would have got stopped out. So even with just that one runner, which I should have done, getting short right there. Stop was there or so. So even if I had taken off 4 there, it's just about 2R, and held one runner, rather than holding that one runner down to just here, I would have been trailing behind each 2-minute candle high, which would have got me down to here, would have had my trail stop there, and then once we broke this low, my trail stop then goes down to this swing high, because that's a 2-minute high that we broke the low of right there. So as soon as we broke that low just there, my stop loss would have gone there, and then eventually get stopped out. But that gives you a lot more R. Like that becomes, for that one contract, would have been almost a 10R trade, versus where I took it off, which was here, which was only 3.5. So could have been worth trailing the stop like that, especially in such a strong move. And that strong move was also seen with, just all these gaps being left open and just a lot of heaviness. So last trade I'll quickly mention was the long I took in here, which hasn't been stopped out yet, it looks like. So despite this being already a blown account, I decided, okay, I'm up 600 on the day, I'm just going to do the personal lockout of my blown account, and jumped onto this account. So I took 2 trades here. The first one was a short, and my logic was simply, because obviously I just locked out for the other trade, logic was, if I'm going to be trailing a stop loss on a short, like if I was short right now, where would I have my stop? Well, my stop loss would have been right here. So I'll jump over to this chart. So we've got 2 minutes on the left. Not having any context really of how deep we're going to go, except knowing we're hitting targets, but we're also extremely heavy. If we were to continue going short, my stop would be at the most recent 2-minute high that we broke the low of, so stop loss would have been there. And when I looked at the 1-minute chart, I figured, okay, well, if it's going to pull back, if it is going to continue low, and we're showing a lot of weakness shown by the fact that we have no wicks here, we're just gapping lower, leaving all the gaps open, so a lot of weakness. This is the first low we've created after a massive amount of weakness, and we left this really long wick, and we're pulling back and then creating this long wick to the downside. So both of these long wicks give the narrative that retail will see that as strong bullish rejection, and whoever's trying to catch the low, this is the first time they're going to be jumping in. And usually, what's the saying? It's something to do with, the first get slaughtered. I don't know. But anyway, so I figured I could just go short there, put the stop where it would be if I was already in a short position, and then just scale out, get to break even nice and early, and continue trailing the trailing stop. So that actually worked out quite nicely. It's getting short, 160 above the short-term high. If I drop to the 1 minute, and then writing that down. So writing that down and taking a partial at the 130s. So just as we hit these lows, that's our rejecting bit. So I took something off there and I was at break even. Taking another 2 off down here, and then getting stopped out 1 at break even. So right here, this is where the long came into play. And this long actually was, like, I was pretty comfortable with it. I was pretty high confidence because we have 10 a.m. making the low, a very high probability time for us to make a low. Right at 10 a.m. consolidated below that 10 a.m. open. We have, if we look at ES, yikes. So ES was making SMT in the lows, so we made a high low initially. As a high low and then a lower low, so that's reverse SMT. We have the manipulation and then the high low NASDAQ with the failure swing. Then start pushing up, and because this is all balanced through here, we know that any fair value gaps should remain unfilled. So I was expecting this to remain unfilled, this BISI. Also, where are the trailed stops? Well, whoever's been short, their stops are either sitting up here, which we probably tapped just about, just fell short. The stops are very high up in the range is what I'm getting at, or they're right here. And whoever did trail their stop, whoever's catching this continuation, had FOMO throughout here, and now they're catching the continuation. They are all now trapped short above, below this high, so they're all short down in this range. So you don't want to see it drop very far into that range. And so as soon as we got this breakaway, I could tell that we were going to keep on pushing. So I got long just here. Sat through this. I was thinking of taking a partial at the hundreds, which is pretty much exactly where we touched. We fell 3 ticks short of the 200s, which is often a good place to take a partial because we can do a situation like this where we make a false high. But I was targeting the 20s, which is just above it, just there. So that was going to be my first target, first TP. So I have to sit through a bit of a pullback. Did just tap into this. I had my stop loss right there. Was a bit on the close side, I would say. I'd say if I was to do this again, my stop loss should have been using this long wick, using the narrative of that wick. That becomes a really nice inversion level. And if I just simply use that, had a stop loss below that, that would have been probably the ideal place. But this is all practice account, so I was very comfortable, and I was actually quite high conviction on this trade. Catching the low after such an aggressive drop, but just the facts that there was nowhere for trailed stops to go, and this high, the narrative of we've got trap shorts below it. So I was quite comfortable getting along here, trusting that this should remain unfilled because it's so balanced within this range. So that's a completely balanced price range, no gaps in here. This is a gap, but there is once again a lot of balanced price action in this range. And yeah, so stuck in it and then took a few partials up here. Just gets to where we are now, but there's the work. So 55 got long. Oh no, there was a stop out. So I actually got long after we'd already pushed up through here, but that's because we had hit this high, begun to reject, and then we just ran straight up into it, leaving this fair value gap. So like, cool, that should remain unfilled. So stop loss below that breakaway, and got long at 81.5, just trying to get below the 80s, but ended up getting filled just there. And I put on 10, and it turns out that I had a, I think 20 handle stop loss, 25 handle stop loss. I'd put on 10 contracts, so I had like $450 risk, which is not what I want. My goal today, as I mentioned, was to have exactly 200 for every trade, just to get used to being consistent. Like, I'm all about dynamic risk sizing, but I need to actually learn to be consistent with putting on some very specific trade amounts, like risk amounts per trade. So took out parts of them and then just sat through this, pulled back, stop losses and below that low. Finally ran up, hit my first TP up at 18.25, so just a bit below the 20s. And then took one more off as we ran up into here. Just I could tell that it was just kind of going sideways a lot. And then I figured that on the 5-minute charts, you could see that this was all very well balanced and we shouldn't really be getting back below the swing low, as you'd consider this an intermediate term low. So I put my stop up to there rather than going to break even. And so far, so good. But we'll see how this plays out. As I mentioned, high time frame is ultra bullish, and we did just have a massive pullback that took out a lot of major sell side pulls. What is going to be interesting is to see what we do as we cross back over these key old points of interest, such as that low there and that low. It'll be interesting to see if we refer to them again. Obviously, this low right here is going to be a key level. That is the old previous day low. We did just drop back below that, so that could also be a very key level to be accumulating position. So that it could very well go up from here. Also notice how we have this high and aggressive sell-off, but the entire time we spent at a discount of this range from this high down to this low. We never got above EQ, meaning that we're in a discount the entire time. And I'd like to see that as accumulation at a discount of this range. And where's the buy side? Buy side is above this premium pull, which is an intermediate term high. Meaning if we hit up there like it is, confirming that's bullishness, but we'll see how that turns out. So yes, that's pretty much my day. I ignored gold today for the most part. I did get slightly destroyed in it yesterday. I was expecting this area to get revisited and tried shorting up in here, which didn't work. This morning I was watching gold in this area, but I did have an inclination that it was likely to rally higher, but I didn't have anything I could see that really made enough sense for me to get involved in it. So as you can see, we had all these internal range smooth lows that we dropped down into, but then in through here, it's just really high resistance, leaving smooth lows above the hourly opens. It's just not a trade that makes sense for me to take. But I do believe we are engineering a high time frame market maker sell model, relatively high time frame, but it's going a lot further than you might expect, and it looks like it might actually be definitely not what I expected. I was expecting some sort of rejection from above this old previous week high. So all these smooth highs up here and then the old previous week high, I thought it would probably come up and reject likely from in here. It still could. But then it does make a lot of sense for us to hit this buy side pull up here, and that's based on my delirium framework. And what the delirium framework is when we have relative equal highs or lows and then a impulse high just above it, you expect it to run out those highs and then also get to that next level. Because if you imagine anyone who's short from this resistance level, they're going to think, okay, cool, resistance, I'm going to short resistance, put my stop loss just a bit above, or at this high just a bit above resistance. And so the market doesn't stop at resistance, it doesn't go a little bit above, it goes a lot above. So whoever didn't want to do that because they're smart support and resistance traders, they know price can color outside the lines, so they do that. Or if they're extra smart, they're going to put their stop loss above this next level, which is exactly where the market goes. These arrows are just based on just something I was testing out where we closed at the high of day with relative equal highs. I want to see the very 1800 open up and take out those highs, and I figured that I just leave an order in overnight with a buy limit just down here to buy when 1800 opens and drops down, and then catch that rally up to make a new high, but it rallied up first. So just testing it out on paper, but yeah. So I'll quickly mention what my goal is for this week. So trading on my own terms, and that is that my executions need to be in my control, and I must be able to define exactly how I am supposed to execute. So I'll copy paste a image real quick. A moment. Let's go up here. So I was watching a video by Alex Hormozi, just talking about focus when building a business, and one of the quote out that kind of hit me was, most people are obsessed about the things in the middle, but on either ends, that's where the highest leverage exists. And he was talking about products, making a really good product so that everyone wants it and everyone's talking about it, or really good marketing at the other end, and that's so that everyone knows about your products. But all the stuff in the middle that you can spend endless time optimizing isn't actually got very high leverage on your business and your growth. So what resides on either end in the context of trading, and what I came up with was precision and control and entries and risk management, because that is what's going to allow you to have high multiples and to really leverage accounts. And I've heard from multiple prop firm owners that the people who make the most money, they are doing that. They are really maximizing the leverage they have available and the risk reward on their trade. So that only comes if I have precision and if I'm fully in control of how much I'm risking and how I'm trading. And that's what I've been doing quite badly with recently. And I commented that that's essentially consistency. That is where consistency comes from. It's from having control in what you're executing. The other end that has the high leverage is a strategy that is fundamentally how price moves. So the market goes up and the market goes down. So if you have a strategy that's to buy and let the market go up and then sell, that is fundamentally how the market moves. Or in my case, what I came up with was to identify an area of accumulation, because the market accumulates, then it moves, and then it distributes. So if I can identify an area of accumulation, then that is fundamentally how price moves. Then the next quote from the same video: if all it did was this, nothing else would matter. Many of your ideas are probably good, but they will all fail because of lack of execution, not because of lack of quality ideas. And that's kind of hit me because if I bring up this real quick, I have a lot of good ideas. Like, it's about entry models. These are just all the models that I've come up with very specific things for. I've got like many examples and fully written out things for each one, and I'm constantly coming up with new ones, and all of them probably work very well, but I'm not executing them quite right. So they'll only fail because of lack of execution versus lack of quality ideas. So I need to be a specialist, and what is this for me? And I was trying to think of, okay, well, if I was to focus on one thing and get really good at it, what would it be? Well, it needs to be fundamental to the market's existence, which is number 2 over here, which I associated with conviction. Like, you have conviction on something because it doesn't have a choice, because that's just what the market is. The market has to do this because otherwise it couldn't exist, which is what accumulation is like. So yeah, fundamental to market existence: accumulate positions at a discount, distribute at premium. So buy low, sell high. That's very fundamental to the market's existence. And then the next thing it needs to have is, with being a specialist, is incorporates the narrative of trapped traders, because I understand that and it gives me the highest conviction. So as I mentioned with a lot of the examples I showed today, when I can tell who is trapped offside, that really allows me to lean into a trade. Like if I know if I know that, if I can read the narrative in price that says, okay, everyone's chasing this short, for example, and I can tell that they were further enticed short and now we're running against them, and they don't have any exit except for this premium high way at the top. So when I have a situation like that, I have the highest conviction, and that would allow me to leverage the most, because if I have high conviction, then that's conviction that's essential for being consistent and for being able to take good trades. So I figured that it needs to incorporate the narrative of trap traders. Gives me the highest conviction, and that can mean many things. Like there's 1,000 different things I could look at that could indicate trap traders, but one of the things that long wicks paints a very nice narrative of who is being enticed offside and who is being trapped. So as a start, that's why I wrote that, because I'm sure I could expand on this idea and come up with something a bit different, more specific, but identify areas of accumulation, which is the fundamental to how price moves, and use the narrative of long wicks to get positioned. So that's kind of my goal this week, trying to work on that. And how I'm starting off with this precision and controls and entries and risk management. And that's really just trying to know exactly how much I'm risking each time. So let's say I have a trade. I want to know that, okay, this is going to be precisely $200 of risk, and obviously the reward's going to be whatever I'm targeting. But I don't want to put on a trade, like if I just buy here, and I have roughly in my mind, it's like, oh, it might be $150 risk-ish, maybe. Enter. I don't intentionally oversize or anything, but then it turns out I'm risking 300, and then I'm like, oh, actually, the stop loss should really be there. And then maybe I get another entry up here, and then all of a sudden I'm risking 400 on a trade that I didn't really plan to be risking that much on. Or maybe I get stopped out on the initial trade, take another one up here, or if I get stopped out, and then I'm like, well, actually, this is exactly where I want to be buying, and so I get in again. So it ends up one trade idea, rather than, risking that initial amount. It could be, okay, one trade idea, but then there's, negative 150 here, then plus 100, but then negative 400, then I win the trade with less size. And so even if I was to win like a 5R trade, but I only risked $100 for some reason because of how I took partials or whatever, and then over here I did the exact same kind of thing, but I risked 450 on this trade, then I have a really big winner with small size, and then an oversized without even intending to loser. So that is not consistent. I need consistency. So today I was just focusing on precisely $200 risk per trade. And if I can do that very consistently, then obviously when I have high quality setups, high conviction setups, I can put on dynamic risk and exponential risk sizing. But until then, I need to get consistent with the exact same every time. And I think that's just where I'm at with the next step I need to take with getting that consistency and getting to where I need to be. Because, this particular combine over here, I was over trading for sure, not executing well at all. And one of the main things was just inconsistency with sizing, with stop loss management, with trade management. I can have a look at the stats. But as you can see, like, terrible profit factor. And if you look at the calendar, it's like 58, 76, 46, 18, 15, 48. I mean, these aren't individual trades. It's probably more like 10, because I take a lot of partials, and every time you take a partial, it counts as a trade. So each of these will be less than 10 trades, but it's still way too many. And when you look at people who are actually doing this and doing well at it, their numbers usually say 2 or 5 or maybe 9 at the most. Like, they never have, anything above 20. Like, you don't see profitable traders that have a 2 and then double digits or more there. So the fact that my average day is like around 40 trades, that's, it's not a good sign, and something that I need to fix. But yeah, that'll do it for this particular review. Yeah, I'll call it at that. I think it's pretty good to go over all that and really look at all this, my goals for this week and what I'm trying to work towards and why I'm doing this. So I don't have any challenges or combines or personal account or anything at the moment. I'm back to demo only, but I'll see if I can use this time constructively to get really dialed in and consistent in my execution, and just try and get something that's consistent going.